Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello everyone, and welcome to another episode of the Executive Real Estate Investing Show. I'm your host, Michael Holman. Great to have you with me this week. This is going to be an exciting week. We're going to talk about financing and all things financing. I'm going to actually give you three tips. The three tips that I have right now if you are trying to finance a real estate investment deal. But as always, we're going to get started with today with our executive tip. Today's executive tip, take care of your health. It is really, really hard to take care of the rest of the things going on in your life if you are not taking care of your health. That's something that you see. We interview a lot of people. We've had a lot of coaches. Health is something that is always talked about, right? So you got to make sure that you're taking care of your body, taking care of yourself physically. Often heard people say, what good is having all the money in the world if you've ruined your health in the process? You can't even enjoy that money and do the things, with yourself, with your family that you want to do. So today's executive tip, take care of your health. Be physically active in whatever you have to do to make sure that you are being healthy. Also, if you have not yet visited the website, I say it time and time again, go visit the website, executivereishow.com. It's a phenomenal place to go get information. You can see all the episodes. If you want to ask an executive question, that is one of my favorite episodes that we do. We usually do it about once a month or once every other month. Love answering those questions. So if you got a question, go on. Ask your question if you're interested in being a guest on the show, if you want to view all the other resources. A lot of good stuff on there. executivereishow.com. Lastly, if you've been listening and you like what you hear, go ahead and hit subscribe on wherever you're listening to your podcast. Love to have you listening every single week. Get the tips. Let's take this investing to the next level, right? It's one thing to just dabble in it. It's another thing to start to really understand. And that's one of the things we try and do with this show is we're trying to give you real actionable items and bring in people who have been there and that can help show you the path that you need to take in order to become a great real estate investor, whether that's passively or actively. Today's an exciting show. The reason I say that, as many of you know, my background, I'm a CPA by trade, got into development. That's where I'm at. I love development. I love real estate development. That's where my real estate investing activities lie, at least a vast majority of them. And I deal a lot with financing. I mean, that's a huge piece of a development is how do you finance a deal? How do you get one of those deals done and how do you get the money that you need? And so what I want to talk about today is I want to give three tips that I have found over the last few years. And these are all the tips that I have, but these are three specifically, that I have found to be very valuable when you're trying to finance your real estate investment. And this is true whether you're trying to close on $500,000 loan or whether you're trying to close on a $50 million loan, right? I mean, the principles that I'm about to tell you apply across the board, right? And I mean, a lot of what we do is in, closer to the 40, 50, $60 million range. But that being said, the principles here, like I said, are still going to apply, whether you're just trying to get into that first fourplex, or whether you're trying to build a 200-unit apartment complex, a storage unit, flex space, whatever the case may be, these are going to help you. So we are going to get right into some of these tips, and we're going to talk a lot about them and why I say them. So tip number one, there is an honest to goodness value for flexibility. When it comes to financing, I'm going to say it again, there is a true value. You could almost put a dollar amount on the value of flexibility. And this goes against the grain for a lot of people. The reason I say that is sometimes your cheapest lenders aren't flexible. And depending on your situation, that could actually end up costing you a lot more to try and go with the cheap lender than to go with the flexible lender or the lender that works for you in your circumstance. I mean, one of the examples that come to my mind is we have a loan that we've just been closing, and we went with the cheapest, which was fine. But the problem is they had a box, right? This is a very traditional lender, super conservative. They had a box, and we had some funny stuff. Not funny, but this was a fairly complex transaction. There was a lot going on, right? I mean, we have TICs, we have preferred equity or mezzanine debt. I mean, we have a lot of kind of just stuff happening in here. And so we went with going with the very cheapest lender. And what ended up happening is because they had this box that they lived in, right? And it was a small box, right? They were just going through deals. Everything had 20 layers of review and approval before anything could get done. You bring them a deal that's a little outside that box. I mean, if it's an inch outside that box, all of them go haywire, right? And you find this a lot with lenders, right? Different lenders have different boxes. And if you got to match up. Some have really big boxes and are really flexible. And those lenders often charge more because they are flexible and because they do have big boxes, right? They can get things done. Generally, they're more expensive. But every lender has a different box, and you need to line up with your real estate investment with a lender's box. If you are someone who's just getting started, it's probably pretty common to just think all the lenders are the same. Right? I mean, you start looking at it, it's like when you get a house. I mean, all the lenders seem to be within like 0.5%. It's not, there's not like huge swings necessarily. There's some that are like way out there, that are maybe higher or lower, but those are the exceptions to the rule. That's not the case, especially when you get into bigger commercial real estate. I mean, if you start getting into bigger deals, not all lenders are created equal in what they do and how they do it and the pricing that they charge for that. Even lenders that might be really huge that you think, okay, I mean, they got to be seeing deals all over the place. There's probably nothing they haven't seen. You would be surprised. Sometimes the biggest lenders are the ones that are the least flexible, right? That happens a lot because you'll have somebody who prepares it, right? You'll have a loan officer, and then you'll have a relationship manager, and then you'll have a peer review, and then a credit review, and then you'll have a loan committee, and it's like all of a sudden you have to get through 100 people, right? I mean, I look at it, two loans in stark contrast that this relates to. I had one loan that we closed, and it was with a big lender, but their flexibility was fantastic, right? They were a little bit more expensive, but this is somebody I could call up. I could call the president of the bank at any time, and I could have a conversation with him, and I could explain, hey, here's what's going on, and here's why I'm doing what I'm doing. Here's why this is structured, right? So I just only had to reason with one person who was a very intelligent, very bright person, and I knew if I got his buy-off, everything else below him flowed through, and I wouldn't have any problem, right? And I paid a little more for that loan, but it closed quickly. It was on time. There was a lot of benefit. I had minimal legal fees, if hardly any, on this. I didn't even have to hire an attorney except to review the loan documents. But I didn't have to hire an attorney to talk with their attorney to get through. I mean, it was very straightforward. Now, on the flip side, right, I'm talking about I got this lender right now. I've had this lender in the past that was that has a very tight box, and they were the cheapest, and we're trying to go with them. Well, it's a very similar, structured almost exactly the same way as the loan that I just described. And the difference there is that, talking about value, I mean, I've probably spent $150,000, $100,000 to $150,000 that's had to be spent on legal fees, even just legal fees, just to get everybody on the same page, right? Because one little change outside the box and you all of a sudden you have 2 or 3 attorneys that all have to get together, they all have to come to a conclusion, they all have to make sense of it, and then they all have to go draft everything, and then they have to come back and they have to do it again, right? And so that being said, you look at it, I mean, that's $150,000. And granted, don't get me wrong, at the end of the day, that's not the only thing going into it, because the lower interest rate more than covers the $150,000. So, math, if you were only looking at those two, you would still go with the cheaper lender, potentially, right? But that's just one of the value points that come with flexibility. Now look at some of the other value points. Time. I was able to close in 3 months on a pretty complex transaction with that flexible lender. Things went smooth as could be, right? And I think, honestly, I said 3 months. It was September to December, but I think it was the end of September to the beginning of December. It was more like 2 months, to be honest, or 2.5 months, not 3 months. Pretty good. And this is a big loan. I mean, this is a $20 million loan. Now, this other lender, right, been at it for like 6+ months, and just trying to get everything together. And you, the issues that you see is you just, there's a value for flexibility. I'm not saying you have to go with an expensive lender every single time, but what you need to do is you need to evaluate your real estate investment, right? And you need to start asking yourself some questions. Is this in the box, right? Does this feel like a standard real estate transaction, right? And if you don't know, that's where my tip number 3 is going to come in. But if you do know, then you need to take some time to think about this, right? Is this a standard real estate transaction? And this is going to transition perfectly into what my second tip is. My second tip for financing your real estate investment is do your homework up front. Remember how I said every single lender is different? You need to do your homework up front to be able to try and avoid disasters down the road. A lot of times you're in this frenzy, right? You're trying to get a deal done, and you're gathering up all the information, and you're getting these term sheets, and you're thinking this is going to be awesome, and you're looking at them, and usually you look at them only quantitatively, right? So once again, understand the flexibility. You're looking at quantitative, all right, this person's going to be the cheapest, this is the person we're going with, right? Well, half the time you might not even know anything about that lender, right? I mean, there's thousands of lenders out there. You have banks, you have debt funds, you have life insurance companies, you have CMBS, you have agency. I mean, you have a lot of different types of lenders and a ton of lenders within each of those categories. It's really common to do a deal with a lender you haven't worked with before, right? If you have not worked with a lender before, it is time to start asking around. I mean, think about the same thing when you're hiring an employee. I mean, when you hire an employee, what does a good manager do? All right, they're going to come in. I'm going to call some references. I'm going to try and, even though I can't know everything about this person before they come and work for me, I'm going to try and gather as much information as I can so that I can make the best decision possible with the information that I have. And I see too many people just rushing into it, right? They don't ask around. They don't try and get references. They don't want to get other people's experience. Hey, what kind of deal, did you have a good experience? Yes. Well, what kind of deal did you do? What did it look like? What was the structure? And people are oftentimes very willing to share these experiences with you, because a lot of times if they've had a great experience, they're going to tell you about that. If they've had a terrible experience, they're going to tell you about that too. And so when you do your homework up front, it avoids a lot of headache. And what I was getting into as well is, what does that specific lender like to do? If you're listening to this thinking, oh, well, every lender, they just probably look at it. If it's a good deal, they do it. And if it's not a good deal, they don't do it. Wrong, right? That is not the case at all. 100% wrong. These lenders have specific requirements. They have targets that they have to meet. Oftentimes out of the control of anybody you're talking to, right? You're talking to a loan officer or a relationship manager. It might be that the bank's board of directors determined that we don't want to do any more multifamily or hospitality or self-storage or whatever it is. And if you go trying to take one of those asset classes to that lender, it's going to be like putting a square peg in a round hole. I mean, it is going to be impossible. And a good lender will tell you and be upfront with you, hey, we're not going to get this done, just period. But heaven forbid you get a not good lender, right? And all of a sudden, you're going down and you find out in the 11th hour, hey, you know what? We're not really doing any multifamily right now. Our portfolio, our multifamily bucket has been filled up, and a decision way above me that I have no ability to change isn't going to change that. I just thought maybe I could squeak the deal in. Right? These loan officers are incentivized to get deals done. Finding a loan officer, it's like any profession. There's really good ones and there's really bad ones. I mean, you can find that in any kind of line of work, and it's the same in the banking world, right? And the good loan officers, they will be very upfront with you and they'll tell you these things as you're going along, right? You might get a new loan officer, someone who's not as reputable or something, and they're trying to force this through the bank the whole time, only to find that the 11th hour you can't even get done what you want to do, right? These are the problems that you need to be thinking about, right? Is you need to be able to do your homework up front as much as you can. And I know you can't get analysis paralysis because guess what? You're never going to have 100% of the information. You're never going to be 100% certain that this lending relationship is going to work or not work. Right? So there is a little bit of a leap of faith, but the more of the work that you can do, the more of the research that you can do up front, it's going to pay dividends. Right? Because usually up front you have multiple lenders. If you only have one lender and that's the only person that's ever going to do your loan, okay, I mean that's a whole nother set of problems that we're not going to get into right now. But generally on the front end, you'll have 2, 3, 4, 5, 6 different lenders that are all interested in doing your deal, at different rates with different terms, and you need to analyze those, right? You need to look at those and if you're thinking about going with somebody, don't be afraid to get in there and start asking hard questions. That lender wants your business, right? They would not be sending you a term sheet if they didn't want your business. You got to understand that this is a two-way street. A lot of times it feels like, like on my end, right? There's a lot of developers that feel at the mercy of a lender, right? And you do have to be, your lender is your partner, and you do have to treat them well. You have to be transparent, right? You have to treat them like a team player. Don't get me wrong, but that lender, if you did your research and they gave you a term sheet, they usually they want your business. These loan officers, these banks, they have lending requirements that they have to hit. They're trying to make money too. And for a bank, if their money is sitting in a bank account not deployed, they are probably losing money. So they need that money to be out there. They need it to be deployed. And they're not trying to lose any of it, and that's why you have to go through the whole due diligence process with them. But they want that money deployed. So the tip number 2 was do your homework up front. Do your due diligence just like you do on any other aspect of the real estate investing process. All right. Number 3, and this is probably one of the most important ones, if not the most important one, and that's get help when and if you need it. I see a lot of people going at it alone, which is fine. You have to understand that there's a lot of lenders out there. There's a lot of complexity that can go into these transactions. And oftentimes you can pigeonhole yourself into a bad situation by going it alone. I'm not saying you have to go out and find a broker who can help you with capital. That's not a requirement. But if you're new, if you don't understand what's going on, or if you're just trying to get a broader reach in the market, right? The way that a broker can help you is if that broker can bring you, say the best you could, let's just take an easy example. Maybe the best loan you could get, you're trying to get a $20 million construction loan, right? You've worked hard, you've put it together, all the investors there, you're working on getting a $20 million construction loan. You might get a 5% interest rate. I don't know, 6%. We'll call it 6% interest rate on a construction loan. Well, there are likely lenders out there that you don't even know about, that you don't even know they exist. Sometimes it can be very much worth it to pay a broker a little bit in points, right? Your standard broker is going to charge you usually around half a point, so 0.5% of the total loan amount they're going to tack on their fee. And that's you can use that as a standard rule of thumb. Some will get really, really aggressive, and they'll try and get to a point and a half. Honestly, the range has got to be half a point to a point. Sometimes they'll get a little bit bigger on smaller loans, but if you're doing big loans, in my recommendation, I wouldn't pay more than a point, and generally I pay a half a point. And usually that broker is also getting paid by the lender, so I can tell you that broker isn't going hungry if you close on a loan with them, because they might be getting a half a point from you, but they're also getting a half a point from the lender. But that being said, the important thing here is, at the end of the day, that's not a lot of money if you're getting a better loan, you're getting something more flexible, you're getting a better rate, you're getting non-recourse, you're getting something like that. If you are getting, it doesn't take a lot, right? But if you're getting something that's marginally better, right? It doesn't even have to be significant. A lot of times if you're getting something that's marginally better, your cost of capital is cheaper using the broker than not using the broker. And not only just on the cost of capital, but also helping you understand what your options are, right? Like if you don't know if your deal is a standard real estate investment transaction, having an experienced broker come in, they can help you know and understand, hey, this isn't, this is really complex, and your opportunities for lending are, they're going to be pretty low. Like, this deal, just so you know, to get it done, it can get done, but you're going to have to go with these lenders. They're going to be more flexible and more expensive. That's probably what's going to happen. Right? They can help give you advice and guide you and introduce you to these lenders that sometimes can be, great lenders for years to come. So if you are feeling uncertain, you don't feel like you know what you're doing, that's okay. Right? Everybody has to start somewhere. If you're feeling unsure, you're feeling uncertain, do not be afraid to go get help. And just like the lenders, do your homework, right? My standard rule, only under the rarest of circumstances will I ever sign an exclusive agreement with a broker. I mean, I don't do it. It's extremely rare for me. That being said, you have to understand it from the broker's side, right? Here's one just broker tip that I'll give you on a tangent really quick. You have a project, don't go out and run out to 15 brokers and with no other instructions and just have them shotgun it out. Because what's going to happen is 4 of those brokers are all going to send it to the exact same lender. And to be honest, that just looks bad. The lender, they're probably, lenders don't like getting that. When that happens, they usually take all those deals and they just ignore all of them. That looks bad for the brokers. They don't want that to happen because that hurts their reputation. And that looks bad on you and the project. Don't do it, right? Don't be the guy or the girl who gives your project to 15 brokers and they just shotgun it out. Now, a lot of times I'll work with multiple brokers, right? But what I do is I get a list from everybody. I say, okay, like full disclosure, there's multiple brokers on this deal, but I want everybody to be playing in a different sandbox. So give me your list and I will ensure that no other broker reaches out. Right? They're not getting paid. You are the only one that will get paid if that lender ends up lending on this deal. And so you can do that. And so you can take advantage of different things. Because like I said earlier, right? You have traditional lenders like banks and credit unions, but you have debt funds. You have CMBS. You have insurance companies. You have hedge funds. I mean, you have all sorts of different types of lenders out there. And oftentimes these brokers will specialize in one or two of those types. I mean, they all say that they'll specialize in all of them, but usually they actually specialize in one or two. So get help when you need it. If you're feeling like you're stuck, go get help. It will infinitely help you in the process. All right, everyone, those are today's 3 tips for financing your real estate investment. Once again, if you're liking what you're hearing, go ahead and subscribe to the podcast. Leave us a rating and review. We'd love to hear from you. We want to get this out to as many people as is willing to listen to it, because we are trying to take you from generic real estate investor to somebody who feels like they have enough information that they can go act and be an honest to goodness real estate investor that can help build generational wealth for them and their families, whether that's active or passive. There's options for both. So we want to get this out to as many people as possible. So go ahead and leave us a rating, leave us a review. And lastly, go check out the website, executivereishow.com. You'll find all sorts of resources, show notes, YouTube, podcast, everything's on there. Go check it out. Thanks, everyone.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.